So, how can you diversify your portfolio by investing in stocks? As stocks and other investment change values over time, investor may find that one or two securities make up a large portion of their overall portfolio. It can be beneficial to occasionally review your portfolio for ways to improve diversification and ensure that your fortunes aren't tied to one or two investments. What is diversification? It is a way to manage risk in your portfolio by investing a variety of assets class and in a different investment within an asset classes. Diversification is a key part of any investment plan, and it is ultimately an acknowledgement that the future is uncertain and no one knows exactly what is going to happen. If you know the future, there will be no need to diversify your investment. But by diversifying your portfolio, you'll be able to smooth out your inevitable peaks and value of investment, making it more likely that you will stick to your investment plan and you may even earn higher returns. Cash also gives it holders optionally. This means that the value isn't from the holding the cash itself, but rather rather from the option cash gives you when the future environment is different from today. Most people tend to think of the investment opportunities available to them currently and ignore them with the might of available in the future. But when you hold some cash in your portfolio, you'll be well positioned to make advantage of any future investment bargains with the next market downturn comes. Uh, Targets debt fund with make it easier. Another way of maintaining a diverse portfolio is by investing in target date mutual funds. These funds allow you to pick a date in the future as your investment goal, uh, which is often retirement. When you are far away from the goal, the fund investment is a riskier asset like stock, and then shifts the portfolio allocation towards safer assets like bonds or cash. So you will get closer to your goal. You'll want to understand how the fund is invested. But this can be great for people who are looking for more of a set it or forget it approach. Periodic rebalancing helps you stay on track. Over time, the size of a holding in your portfolio will change based on how the investment performs. Holding the holding with strong performance will become a greater percentage of your total portfolio, while worse performance will see their weight decline. In order to maintain a diverse portfolio, it is generally a good idea to rebalance the portfolio occasionally to be opportunate wait for each investment. You probably won't need to do this more often than quarterly. You should be checking on these things at least twice a year. Think global with your investments. With so many different investment options available in US, it can be easy to forget about the rest of the world. But in global economic, there are increasingly attractive opportunity outside a country's border. If your portfolio is entirely focused on the US, it might be worth looking into fund focused on emerging market or Europe. As countries like China grow at faster long-term rate than the US, the company based they are benefit. So it can be also a way to better protect yourself from a negative events that might impact the US exclusively. All other markets may not suffer as much if the US sees the economic shutdown, slowdown. Of course, the reverse is also true. Emerging markets sometimes face challenges due to their underdevelopment economic and financial markets, which can be uh, which can cause bumps on their long-term growth treasuries. But diversifying your portfolio is about smoothing out the inevitable bumps on no matter where they are come from.